Welcome to today's Explainer, where we're diving into the based token mystery, investigating a massive 500% volume anomaly, and decoding crypto value traps. We're going to use the based token as our prime suspect today to figure out exactly how market mechanics can totally distort reality. We'll be bridging that gap between a project's incredible utility and the hidden architectural traps that catch even the most seasoned traders completely off guard. So this whole mystery kicks off with one absolutely wild, undeniable number, 509%. That's the volume to market cap ratio we're looking at here. Now, just for some context, established cryptocurrencies usually sit somewhere between 5 and 15%. So hitting 509%, that signals something extraordinary is happening. It's either an explosive organic discovery phase, or we're looking at a highly coordinated cycle of wallet rotation. To really wrap our heads around this staggering contrast, a $28.2 million market cap versus $143.5 million in trading volume inside a single 24-hour window, just picture a supermarket. Imagine that supermarket completely selling out of every single item on its shelves, restocking the entire inventory, and then selling out again. Now imagine it does that 5 times in a single day. That is the sheer velocity of capital moving through this asset. It's literally off the charts. Seeing that massive volume, we've got to ask ourselves a pretty serious question. Is this uniform buying pressure a sign of genuine interest? Or is it a giant red flag waving right in our faces? Are we looking at a modern digital gold rush driven by real user adoption? Or is this just a totally dangerous speculative frenzy? Well, to find out, we need to strip away all the noise and objectively look at both sides of the coin. Let's start things off with the optimistic view, the super app bull case. The official pitch for Based isn't just another simple token trying to enter an already crowded market. It's actually a really grand, ambitious vision to dismantle financial borders and unify trading, spending, and artificial intelligence into one seamless, consumer-friendly app. And honestly, the real substance being promised here is massive. We're talking about spot and perpetual futures trading powered by the Hyperliquid network, direct access to hundreds of polymarket prediction events, and a crypto-linked Visa card designed to work at over 70 million merchants globally. They're even building autonomous AI-powered trading agents. Essentially, these are bots that can own wallets and execute trades for you. It's a massive, multifunctional ecosystem. Plus, this isn't just marketing hype. The project boasts some serious financial validation. They had an $11.5 million funding round led by Pantera Capital, alongside heavy hitters like Coinbase Ventures and Wintermute. When institutional giants like these back a project, it means they've heavily vetted the tech and see viable infrastructure. These players don't just throw millions of dollars at empty promises. Throw in the fact that they have a rapidly growing base of over 100,000 active users who are actually generating real revenue. We're talking millions of dollars, and this bull case looks incredibly compelling. Real utility, massive institutional backing, and a growing user base, it all points toward a huge success story. But there's always the other side of the coin. Let's look at the bear case, where the on-chain data paints a terrifyingly different picture. We're talking about red flags and value traps. Because right behind that sleek app interface and those impressive venture capital names, the actual tokenomics and market structure are flashing bright red warning signs, the kind that retail investors almost always ignore until it's way too late. The most glaring red flag right out of the gate is the extreme ownership concentration. On-chain data reveals that the top 10 wallets hold an astonishing 92% of the current token supply. Just 10 wallets. When so few people hold so much of an asset, it creates a massive structural risk for price manipulation. The price discovery here isn't organic, it's basically controlled by a tiny, highly concentrated group. And that level of concentration, mixed with a speculative frenzy, leads to exactly what you'd expect: devastating volatility. We watched the price surge to an all-time high of roughly 31 cents, only to suffer a brutal 72% crash down to under 9 cents in a matter of days. For any retail trader buying into that momentum, that is a violently fast loss of capital. This whole situation brilliantly illustrates a classic concept: the value trap. A value trap happens when an asset appears cheap based on traditional metrics, but it's actually structurally flawed or in terminal decline. Retail traders get lured in by a massive price drop, thinking, hey, I'm getting a bargain, or I'm buying the dip, while the core structure of the asset is actively collapsing against them. That lower price, it isn't a discount. It's just the market accurately pricing in a bleak reality. The crazy thing is, most retail traders fall into these traps not from a lack of knowledge, but because of deeply ingrained structural habits. We've all seen it. They size their positions emotionally, they throw more money into a losing trade just to average down, they hold on to losers way too long just to avoid actualizing a permanent loss, and they completely ignore how transaction friction and fees slowly bleed their accounts dry. It's a psychological trap just as a financial one. So this leaves us with a massive contradiction. How can the bull case, with its incredible super app and tier 1 investors, and the bear case, with highly manipulated wallet concentration and a 72% crash, both be true at the exact same time? To solve this puzzle, we really need to find the smoking gun. Well, the answer lies entirely in the tokenomics. Remember that $28 million market cap we marveled at earlier? Yeah, it's practically an illusion. It's based solely on the 23.5% of tokens that are currently circulating. A staggering 76.5% of the 1 billion total tokens that will ever exist are locked away right now. The market cap only looks small because the supply is being artificially restricted. When we break down the allocation of that 1 billion supply, it reveals that massive portions are reserved for early investors and core contributors. We're talking over 40% of the entire supply dedicated to the folks who built and funded the project early on. Now, while that is common in crypto, it represents an enormous amount of hidden risk for the everyday retail buyer. And this specific allocation schedule creates what analysts actually call a supply time bomb. While the initial launch restricts the supply, the future is already totally mapped out. We see a 20.41% unlock hitting in May 2026, but the real shock comes in March 2027. That's when over 400 million tokens reserved for investors and the team are scheduled to unlock. This predictable, heavy selling pressure is mathematically guaranteed to flood the market, which will massively dilute the value of anyone holding the asset today. All right, now that we've uncovered the hidden mechanisms driving this based token mystery, let's distill this whole investigation into a practical toolkit, your Crypto Analyst Toolkit. You can use these exact same principles to analyze any market opportunity out there, allowing you to sidestep the traps that usually catch about 90% of retail traders. First up, you've got to use technical indicators to strip away the emotion by combining your fundamental data with tools like the Relative Strength Index, or RSI. You can measure actual market momentum. The RSI helps you clearly see if an asset is technically overbought in a hype cycle or genuinely oversold, rather than just blindly following what social media influencers are yelling about. Beyond just the indicators, applying a really simple 4-step framework will instantly elevate your strategy. Step 1, check that volume to market cap ratio to spot artificial velocity. Step 2, ruthlessly examine if you're looking at real utility or just marketing hype. Step 3, always find the token unlock schedule so you can spot those hidden supply time bombs. And step 4, ask the most basic question: does this token actually do anything useful in the real world? So I'm going to leave you with this final, absolutely crucial thought. The next time you see a token going absolutely parabolic on your charts, ask yourself, are you buying into real, sustainable utility, or are you just buying the hype of a mathematically manipulated supply? Equip yourself to see the whole picture, look at the underlying structure, and trade with logic. That way, you don't end up becoming the exit liquidity for someone else's locked supply. Keep questioning, keep learning, and as always, stay focused out there.